What's up, guys? Welcome to Joy of the Trade. This is my weekly wrap up where I go through what happened this week and I look back at my Monday predictions for some of the biggest things that were going to move the markets and just see if I was right or wrong, see what happened, what the F happened, why it happened. Let's run through it. So on Monday, I had pinpointed retail sales in the middle of the week as being the big inflection point as to what was going to move the needle from an economic release standpoint. Now, we have had CPI that was much more tame than expected last week, which was bull juice. That's what they needed to get stocks going higher. We've had better than expected lousy earnings. So lousy earnings that were slightly better than expected. So not super lousy, which drove stocks up like crazy. That season is ending as we speak. We're at the tail end of earnings reporting. And I'm just looking for different catalysts that are going to move the market. So let's take a look at what happened, where the market went when it happened, and go from there. So we had the retail sales number here. If you follow my cursor, we came in at 0, right? So we were expecting 0.1% retail sales month over month increase. We got 0. A lot of that is due to the fact that energy prices came down in July. So you see, if you take it out, X auto and gas, it was a lot higher. It was a lot. Retail sales was higher by a good amount. So definitely, it's not an inflation adjusted number, but it did some strange things. Strange things occurred from that. So if we look at what kind of is stressing the market a little bit, is this 10-year yield. This is the yield that everybody's always staring at, and it's up again today, which is why. And I'm filming this obviously Friday morning pre-market before the stock market opens. The future's down pretty good. NASDAQ off 1%, et cetera. S&P almost 1%. But we have had this move where we just bounced back above this week. So if we look at the last 3 days, because the retail sales were released this week, we had rates which started in the low 2.8s, back right at 3% almost. So this is a negative stress. This is going to be a negative stress for growth stocks. Going to be, let's see what ARK did. So I'll show you what, like, growth without earnings, which is Cathie Wood's fund, ARK. What did that do? This is the blue line here. That had an inverted reaction. So the price of ARK, which is an ETF, started the week around $52. We got this, let's call it what it is, stronger retail sales ex gas, which means the Fed has more ramp to raise rates. And so rates went higher and growth stocks crushed. Pre-market, this thing's down to 46. So from 52 to 46, we're looking at what, $6? We're looking at a 15% move almost in this ARK in 3 days since this thing came out. So that's going to keep moving the needle next week too. So that's going to be something you got to pay attention to next week. So if we get this move back in rates, which is something I'm really paying close attention to, back up into the 320 range, this level here, we're going to see these stocks really take a nosedive. These growth without earnings, and those are all the ARK stocks, Teladoc, all these stocks probably going to get hit. The other thing that I was looking at to start this week was Target. I was looking at Target, which, if we look at Target stock, has had a nice run after gapping down. They had their earnings. The earnings came out, and the stock opened higher, and it's just since sold off, and it's selling off again. Now, I expect it to regress that back down to like the 160 range, but they generally did okay, believe it or not, on their earnings. So they did the old trick. They got everybody to expect the worst, and then they delivered not so much the worst, but the stock is still selling off with the rest of the market. It hasn't bucked it. And if we look at earnings history, check this out. This is a pretty cool feature on Bloomberg. We can see that the stock was down 2.69%. So this was important. They earned 46% less than they were supposed to. And that's because they took a big charge down. They took a big write-off. They had a lot of inventory that they couldn't sell. And so they wrote it off. It wasn't a sales problem. It wasn't a top line thing. It wasn't a revenue problem. they had to take a loss on their inventory that they had too much of. That's a sign of the company not managing things really well, guys. So we'll see what we have next week. So yeah, so I thought Target would be worse, but the stock's still bad. I thought the stock would do bad, and I thought retail sales would cause selling in the market, and it has. So let's see what happens next week. But in the meantime, before you head out, my boy Lance and I are hosting a special event, Blitz versus Burnathon. And we have limited spots for the in-person event. It's going to be in Ponte Vedra, but you can also watch this thing from anywhere in the world. It's going to be a trading workshop. So it's going to feel right like you're sitting next to us from the comfort of your home if you do it virtually, or you can join us in Ponte Vedra. We're going to share our best tips, tricks. We're going to analyze the market in real time. I'm going to use all my old hedge fund tricks, all the stuff I learned on the prop desks. Lance is going to show you how he sees option flows, and we're going to dissect the market. You're going to look at all our indicators. You're going to see us in real time making decisions. We're going to make mock trades. We're going to do it together. You're going to learn about pre-market planning, fading the close, overnight move reviews, and all dozens of tips that we'll have for you. So get more information at the link below and see you there. If you like this, like it on YouTube, sign up at joythetrade.com for all my reviews. I'm here all the time doing this kind of stuff. So LFG guys, have a great weekend.